Everyone, good morning. So, today we are now going to start with loan term, loan term A. Previously, we have discussed about debt, we have discussed about bonds, we have discussed about amortization, we have discussed about tranches and securitization. And now the detailed part. Uh, Now we are going to apply these concepts. This is where everything starts, and this is where everything begins. Uh, Previously, all those episodes were prepared so that you can understand, you can have a better understanding of what we are going to study now. So let's start with a question that why does loan term matters more than you think? So there are different So there are very simple but powerful ideas in finance. Time means time is risk. So when we say loan term, we are not describing how long a loan exists, but we are describing how long capital is at risk and how long cash flows are obligated and how uncertainty compounds over time. So formally, a loan term is it's a period for from disbursement of funds to total repayment or full repayment, but economically it represents the contractual timeline of risk sharing between the borrower and the lender. And now, when financial documents say loan term A, they are being very precise, and this is not a casual language. It's actually a signal. It actually specifies a specific tranche of debt with explicit rules around repayment, maturity, pricing, and control. Uh, Pricing and control and risk, and a very clear position relative to other debt instruments such as term loan B, revolvers, and uh, other kind of loans, etc. So understanding term loan A is actually essential because it actually sits at the intersection of the risk, cash flow, and control. And when we talk about the economic identity of term loan A, so term loan A is best understood as it's a medium-term amortizing bank-controlled loan designed to steadily reduce credit risk over time. So medium-term, regular principal amortization offers primarily by bank offered and considered low risk than other term loans. And its defining characteristics are that it's a medium term loan, regular principal payments, regular principal repayments. Amortization means repayments. And primarily, it's actually provided by commercial banks, uh, not so commercial banks. It's a business. We are talking about it from a business perspective and not retail banks, but commercial banks. So commercial banks. And there is a lower risk relative to other leverage loans. So low risk because of that, it's a low risk. But here is the key insight. Term loan is not about maximizing return, it's about maximizing minimizing uncertainty. So term loan A, when you have a term loan A, you as an investor do not want to maximize return. If you are having a term loan in your portfolio, or if you are having a term loan A in your company, then it's not about maximum returns, but it's about minimizing uncertainty. So this is why it is widely used in corporate finance. This is why it's widely used in leverage buyouts, and this is why this is used in project financing, structured lending. So whatever predictable cash flows exist, term loan A thrives. So wherever. So now let's talk about the key characteristics of term loan A. So the term loan A, the key characteristics. Okay, so loan term A typically matures in 3 to 6 years. Uh, why does it matter? Shorter maturity means less exposure to microeconomic shocks, lower uncertainty around business cycles, and it actually reduces the refinancing risk. And compared to term loan B, which is often stretched beyond 8 years. Term loan A actually reflects a bank's natural preference for visibility and control. And in other words, bank do not like long promises; they like measurable progress. When we talk about the repayment structure, so amortization as a we can use amortization as a risk control. uh, So this is actually a defining feature of term loan A, loan term A. So loan term A requires regular principal payments. Yes, monthly, quarterly, or annually, and often little or no balloon payment at the end of the maturity, because if there is a balloon payment, it's actually increasing the risk. Let's take an example. We actually have an example here. So if there is a 5 year term loan and there is a 20% principal repaid each year, this means that it's actually there is actually it's not a long promise, but there is an actually measurable progress, and this actually reduces the lender's risk and borrower's leverage over time. And every principal payment actually reduces leverage. Every principal payment actually reduces leverage means debt basically, and in this context, leverage means debt. So leverage reduces every principal payment, and it shrinks the downside risk with every principal payment, with every installment, and every with every principal payment, it transfers uncertainty uh, away from the lender actually. And this is why amortization is not just accounting, it's actually risk management embedded in cash flow designs. So when we talk about amortization, it's more towards the impact is risk management uh, with the help of cash flows. And whosoever control the cash flows, they control the risk. Now, when we talk about the interest rate of a loan term A, so pricing the remaining uncertainty is done through lower interest rates. So loan term A typically carries a lower interest rate than loan term B. Uh, Floating rate structure, there's a floating rate structure means that it's usually priced as SOFR plus LIBOR margin, or LIBOR margin, SOFR or LIBOR plus the margin means that uh, a specific margin is going to be constant here, like 200 basis, and the interest rate will depend on the SOFR or LIBOR rate. So these rates change every day, and based on that, the interest rate would be decided. Let's assume that interest rate SOFR or LIBOR rate increases. So this means that this component also increases. And if these rates decreases, so this will actually also decrease, and that will be beneficial for the borrower. And if the rates increase, uh, the investors will hedge the risk. So investors will get something extra for the risk they are actually taking. And from a valuation perspective, this means that the lender is compensated more through uncertainty of repayments uh, than their yield. Now, the risk profile of a long-term A is who is actually taking the risk. The risk profile actually tells us that who is actually taking the risk. And from a lender's perspective, when we talk about it, so there is a lower credit rating and faster recovery of capital and a strong contractual protection also. But from a borrower's perspective, higher near-term cash flow burden is going to be there and less financial flexibility along with continuous performance pressure. So, and why is risk lower for lenders if we talk about this? So, this is because there is a faster principal reduction, shorter maturity, and tight covenants. And this is a trade-off. That's why lower interest cost in exchange for higher discipline. Faster principal reduction, shorter maturity, and stronger covenants protection is there when we talk about loan term sales. So, covenants are the do's and don'ts, do's, do and don'ts, which comes along with the loan. Covenants is not a Uh, I mean, covenant control is not optional here in long term A's. Long term A comes with strict financial covenants, often including debt to EBITDA limitations, interest coverage ratios, cash flow or liquidity tests, timely cash flow and liquidity test. And these covenants exist for two reasons, to protect the lender and to force behavioral correction, behavioral discipline to borrowers. And covenants are not punishment, they are just feedback mechanism. They ensure that problems are addressed while they are still small. Now, let's uh, talk about who uses loan term A. So, loan term A is actually used by, it's majorly used by borrowers. So, loan term A is ideal for established companies. Businesses with stable, predictable cash flows, they can use loan term A. Firms where they actually prioritize lower cost of capital over flexibility, and these are not speculative borrowers. These are cash flow businesses. When we talk about lenders who prefer long term A, so these are commercial banks and syndicate bank groups. So they prefer long term A because it amortizes. It's a covenant. It's covenant heavy, and it aligns with the regulatory capital rules. So that's why lenders also prefer uh, loan term A to give out loan term A. If we compare the loan term A as with loan term B, so you can see that there is a mature. The loan term A actually has a maturity of 3 to 6 years, which is shorter in nature, and loan term B actually has a maturity of 6 to 8 years, which is considered long term. Amortization is high, but it has a lower bullet amortization. When we talk about interest rates, so interest rates are lower for a loan term A, but for a loan term B, the interest rates are higher, and this actually is dependent on the time frame. So the longer time frame means there is higher uncertainty, and lesser time frame means there is lesser uncertainty. When we talk about the risk with loan term A is lower, but the risk with loan term B is actually higher. Lenders are banks, and for loan term B, these are institutional investors. Covenants are tight here, and covenants are light here. Tight and light. We will discuss about loan term B in our next reading in detail. So the interpretation of this whole table is that loan term A actually prioritizes risk reduction. So a loan term A talks about risk reduction, and long term B actually prioritizes return maximization. Financial advantage, there are financial advantages also of long term A. Uh, so when we talk about the financial advantages of long-term A, we need to uh, pay attention from borrowers, as well as we actually have to look at it from a borrower's perspective and from a lender's perspective. So from a borrower's perspective, uh, so there are lower interest cost, and borrower would prefer a borrower. If you are a borrower, you would prefer lower interest costs. You would uh, you would prefer faster deleveraging also. Uh, and because of lower interest cost, so these are related to each other. So if the interest is low, so they are expecting, the issuers are expecting that it will be faster, it will be fast, it will be paid back faster, and this will actually improve the credit metrics over time. And when we talk about from a lender's perspective, now think about it that the predictable cash flows are actually helping the lenders. These are favorable to lenders, and because of this predictable cash flow and faster deleveraging, this is actually reducing the default risk also. And since there are covenants, uh, the lenders can strongly monitor these loans, and this is something which reduces the risk for the lenders, and in return the lender actually lends the money to the borrower at a lower risk. But since we are talking about the advantages, there are obvious disadvantages also. When we talk about which are, I mean, there's obvious disadvantages also with loans, with term loan A. So there is higher required cash outflow, higher required cash outflow because because they believe in faster deleveraging. Because of faster deleveraging, there is higher periodic cash outflow. It actually also reduces the flexibility for the borrowers. And there are continuous covenant compliance, because if the covenants compliances get a breach, the contract gets void, and no, borrower would want that. And if the lender finds out that there is a breach in the contract, so there might be penalties. There might be penalties, which are which might be which might be a part of the contract. So if there is a breach, then the borrower might have to pay a penalty for the breach, and then fix all the uh, fix all the compliant ratios, or all the covenants back to the discussed numbers. And when we talk about it from a lender's perspective, now think about it: a lower yield compared to riskier instrument is a disadvantage. So if the risk is high and there is a lower return, so this is actually a disadvantage for the lender. And safety always costs return. So this actually need this is actually a disadvantage from a lender's perspective. Even though there are many advantages, there are still disadvantages when we talk about long term. So now let's talk about the accounting and the financial impacts of long term A on the balance sheet. So long term A actually appears on the current portion of the balance sheet, which is, I mean, that portion which is to be due within 12 months, that will be the current portion, and the remaining portion that's going to be the long term, that long term debt that will be on the remaining balance sheet. long-term debt under long-term. So this is going to be a part of current assets, and this is going to be part of non-current assets. When we talk about the principal cash flow statement, so principal repayments would be a part of financing activity. So principal, if I am paying back the principal, so that's going to be part of financing activity. But the interest payments are going to be a part of operating activities. These are the financial impact, financial accounting impact, which comes from loan term A. So loan term A, why not the whole payment? We can why we cannot process the whole payment through financial activities, and this makes sense here because we have raised debt for our operations, and the interest is actually a part of operate. The interest has been a part of our. Okay, we have raised debt. Now understand this thing. We have raised loan term A to support our operations, right? So this is going to be a part of our core business activities. And because interest payment is actually, think about it, interest payments is a part of your income statement. So that's why the interest component is run through operating activities. And the principal payment is run through financing activities. I hope this is clear. Don't get confused. You can revisit this part one more time, no issues, but understand the logic behind it. Unless until you understand the logic behind it, it would be confusing for you. Okay, now the uses in capital, the role in capital structure of loan term A. When we talk about the role of use in capital structure, loan term A often sits at the senior secured. It's a senior secured loan, yes, above subordinate debt. Loan term A is above subordinate debt. If you remember in tranching, subordination, this is the process of subordination where the risk actually goes from the bottom tranche to the upper tranche. That's subordination. And senior secured, this part, senior secured at the top layer, senior secured sits above the subordinate debt. So there are different type of debt. So this is, it sits above subordinate debt. So I'm assuming that this is just debt. XY, this is some kind of debt. But loan term A is a senior subordinate, senior secured debt. So this will sit above subordinated debt. The subordination is the process of classifying these on the basis of risk and on the basis of priority. When we talk about down, up to down, that's basically subordination. And alongside revolver and term loan B, the subordination senior secured is the first preference, and that's why lower interest rate, but assurance to pay back, and for assurance they have embedded covenants so that uh, you can also track the uh, performance of the company. You can also track the performance of the borrower, company or borrower. So now I think this actually makes sense. What does covenants mean? And the more the secure the loan, the more covenants would be with the loan. And now I think I hope that if you are watching this video, if you are attending this lecture, so now it makes sense to you why lower covenants, why lower interest rates, and why there are covenants embedded in senior secured loan, because they want surety that they will get their money, and this is one way to hedge risk, the covenants tracking. Okay, so so it plays actually. We were discussing about senior secured. So another point here is that these are above subordinated and mezzanine capital, and alongside revolver and term loan B. So term loan A and term loan B, so these are similar in structure. So then, if we talk about revolver and term loan A and B, so these are somewhat around similar in nature. These are all loans. These are all debt securities. And it actually plays a very stabilizing role, balancing the uh, cost of capital, risk, and liquidity. And where you see, and, and where will you actually see? When will you actually see a long-term A in practice? It's during merger and acquisition financing. Yes, if you are looking at the financials of a merger and acquisition, recent merger and acquisitions, then you will see a long-term A. If you're looking at corporate refinancing, you will see long-term A. If you look at private equity transactions or project in infrastructure finances, so loan term A, there is a very high probability that loan term A they might have used, they might they might have a loan term A in their capital structure. And whenever banks are involved, loan term A is usually present. Loan term A are actually usually present. Uh, and one more thing, in real estate REITs, it's very common in REIT. If you look at the capital structure of a REIT company, real estate investment trust, the loan term A is very common because of the involvement of bank. Because nobody is having that much disposable income to invest, and because of that, they actually there's a high possibility and high probability that banks are involved, and loan term A's to contract to track and monitor are it's very common. I'm not saying 100%, but it's very common. Okay, and finally, the final summary is how to think about a loan term A. If you were to think about loan term A, so loan term A is actually conservative, not aggressive, so conservative, amortizing, and bank friendly loan structure designed to reduce leverage steadily, minimize credit risk, and provide predictable repayment schedules. The fundamental trade-off is simple. It's less flexible. It's less flexible and a higher short-term cash pressure on. I mean, higher there is higher cash flow pressure for lower interest cost and financial stability. And if you understand term loan A, you understand how the real world debt market actually function. And uh, since we I think that I hope that during this episode you were able to connect how covenants are related to long term A, and this will be very helpful to us when we talk about uh, the other type of securities. And here we will be only talking about the in during this debt structure instruments, we will be only talking about the debt securities. That's what we are going to talk about. And there are multiple types of debt. And okay, then I hope this was it for today. So I'll see you in next episode. My name is Deepak Best, and thank you for attending this lecture.